If you've been watching the market lately and thinking, this feels a little off, I don't think you're wrong. In fact, there are several things happening right now that I find not just unusual, but actually alarming. And I want to walk you through exactly what they are, why they matter, and what I'm personally doing about it. Now, what are some of these signals? Well, you've probably seen them before, but others, you won't hear them anywhere else on YouTube. They're subtle, but they're serious. And if you understand them, you'll be miles ahead of the average investor who is chasing hype without a clue. Let's start with what's going on in the NASDAQ right now. Guys, the NASDAQ is awesome. It's up 55% since April of this year. That's an enormous move. And normally you'd say, great, stocks are going up, what's the problem? That is what a normal investor would say, but here's the problem. A large part of that performance is driven by companies that, frankly, aren't making any money. No profit. In some cases, little to no revenue, and yet their stock prices keep exploding. This kind of setup is exactly what we saw in 1999 and 2000. Back then, everyone was piling into tech stocks because they were the future. Yeah, they were the future. Does that sound familiar? The internet was going to change everything, and it did. But that didn't mean the prices made sense. Does that sound familiar? That's what we're seeing again today. Everyone's talking about artificial intelligence. It's the future. It's revolutionary. Yes, it is. But just because something is the future doesn't mean every company attached to it is worth buying, especially at any price. If you guys look back at history on car companies and airlines, they've lost money for countless people. Thousands and thousands of car companies, thousands and thousands of airlines have gone bankrupt in the early part of last century. But guys, the future was cars. The future was air travel. Guys, look at this. The best performing stocks in the NASDAQ this year, average year-to-date performance of companies in each category, 34% leads the way. No revenue. Zero revenue. Mag 7 is 18%. Guys, profitable small mid-cap 5%, profitable NASDAQ 7%. S&P 493 is 8%. NASDAQ with revenues, I mean, this is insane, guys. This is what I want you to remember here. Now, guys, even more alarming, the top 10 companies in the NASDAQ 100, Nvidia, Microsoft, Apple, Google, Amazon, Meta, Broadcom, Tesla, Netflix, Palantir, and Costco. They're selling for 56.5 times last year's free cash flow. Historically, companies sell for between 15 and 16. These are great companies, so call it a premium of 20 to 25. That's an insane premium right now. The bottom 10 are selling for 20 times last year's free cash flow. That's a massive difference. And those companies include some big old names like Kraft Heinz, CoStar, Old Dominion, Lululemon, CDW, Biogen. These are companies in that. Now, another sign to me to make it more concerning, cryptocurrency is running again. It's part of the same pattern. Speculative assets are exploding. Investors are chasing returns and fundamentals are being ignored. Guys, crypto is not driven by investors and there are no fundamentals. The best argument crypto has is it's limited. If I take a shit in a bag, it's limited to that one bag of shit in the world. Does that make it worth a lot of money? When these riskier bets start flying and everyone feels like a genius and they're criticizing the geniuses who ignore it, it's probably an indication of where we are. Now, when's that going to end? I have no idea. But crypto, guys, is purely an asset that's a tech play. That's it. It has no intrinsic value. Anyone who says otherwise is just trying to convince themselves of something that doesn't exist. In its current form, crypto will not work. The government doesn't want competition to its own currency. And if they adopt crypto, the same arguments they make for crypto being awesome against fiat currency makes it a fiat currency. It is so freaking stupid. But this is a sign of the times, that we have to believe in something that has no intrinsic value. Now, one of my biggest concerns, and the one that's most obvious and we have historical data on, is the one that people are ignoring a ton. The stock market to GDP ratio, valuations. This is the stock market GDP ratio that I have created based on the S&P. It's one of the most basic and easiest valuations tools we have to see if the market is expensive right now. Warren Buffett even says that. And right now, guys, it's flashing red. In fact, we're near the most expensive levels in history, on par with where we were before the dot-com crash. I'm not saying the market's going to crash tomorrow. That's impossible to know, because in the short run, stocks are a voting machine. What I am saying is this. When price disconnects from value and reality by so much like this, when easy money is being made without discipline, it's usually not a sign of good times. It's a sign of euphoric times, and those don't last. Now, there's a lot of criticisms. Actually, there's one main criticism of the stock market GDP ratio, and those criticisms are usually given by morons. What's that criticism? Well, Paul, GDP includes so many of these companies sell internationally, it's not included. It's 1% difference. I'm not saying this is perfect, but it's a very reliable metric right now, and it makes perfect sense. The entire GDP of a country should match in some ratio the companies that make up that country. The S&P 500 is companies in the U.S. in the S&P that are based here. We're at 122% overvalued. If you look at history, this is undervalued by over 30%. This is going to overvalued by over 50%. As you get more overvalued, what happens to the 10-year returns? They decline. And it makes perfect sense. The more you pay for a future stream of cash flow, the more you pay for an investment, the worse your investment will do. It's just logic. Now, let's pause for a second. If you're new to this channel, here's what I want you to know. I'm not making predictions, and I never will. I don't sell hype. I don't care what the next hot stock is. I care about one thing: buying great companies at great prices and dollar cost averaging into low-cost ETFs. That's it. My predictions I might make are long-term predictions. I've said countless times the next 10 years are not going to be as good as the last 10 years. And you might sit there and say, well, of course, Paul. Well, you'd be surprised how of course that is. A lot of people don't believe that today. This is what principle-driven investing is about. It's about managing our expectations for the future. So when I say the stock market looks terrifying right now, I'm not saying this to induce panic, and I'm not telling you to panic. I'm saying this should concern you and make you aware of what the future could hold. Does it sound fearful? Does it sound like a futster? Sure it does. I get that. But I'm here to tell you that the future is far more optimistic down the road than it is today in terms of stock market values. That's okay. And I teach on YouTube for this exact reason. I think we're too short-sighted on the way in which we invest. I think it's wonderful that I'm like the only channel that talks about 20, 30, 40 years from now. It talks about teaching a process. And let's talk about why this matters and what you can actually do about it. First, I want to show you something surprising. What percent of Americans do you think are invested in the market today? I want you to take a guess. Statista says that 62% of people own stocks today. Now, going back to 1999, look at the highs. .com, peak before great financial crisis, when valuations were the best, people didn't own stocks. Now, the differences are not huge, 65 to 52%, but it does matter in looking at this. Guys, when people are all going into an investment asset, it usually means there's probably too much euphoria happen. When people are leaving investment asset, it's a time to take a look and say, what is everybody missing right now? Everybody in the world wants to talk about how everybody out there is so stupid. Yet in investing, it's the one area where we love being around everybody to say, this is a great time. Guys, easy money is a bad thing. It's not a sign of great times. It's a sign of euphoric times. If you look at how money flows throughout the economy and history through investments, the best times to buy were when people were avoiding it. Always. Most people only start investing when stocks feel safe, when they've been going up and up and up, and when the news is good. But remember, news follows the stock price. When stocks go up, the news to justify that comes out. When stocks go down, the news to justify that goes on. But it's backwards. Historically, the best time to invest is when things feel the most uncomfortable. Think about it. When was the best time to buy real estate? Was it 05 or was it 08 to 12 when nobody wanted to touch it? I remember people telling me they were toxic assets. I'm like, imagine a house that I could rent for $1,500 a month and selling for $75,000 was considered toxic. When was the best time to buy? Was it in 99 or 2000, or was it in 2003 when stocks bottomed? Or was it after the crash of 2009? Or in 1970s when inflation scared everyone out of the market? These are the best times to buy. Yes, it's the scariest time to buy. And that's exactly why you need to surround yourself with like-minded investors. That's why it's so important. Because when everybody's scared, you need to be around people who can sit there and say, we've been through this before. We've seen this before. It all plays out a certain way. And that is exactly why this moment is so dangerous. People are piling in, not because they see value, because they see a price going up. And that's how fortunes get wiped out. Even if you don't have a fortune, that's how you lose money. So what should you be doing? Well, when the market's overvalued, like it is right now, I still keep buying my low-cost ETFs, and you should as well. I still buy undervalued businesses when they sell at good prices. But when the market falls below fair value, that's when I'm going to buy even more. Let me give you an example. Let's say you normally invest $500 a month. When valuations are high or fair, stick with it. But But when the market dips well below fair value, based on something like the stock market GDP ratio, you might want to consider increasing that $500 a month. That's how you can outperform the market without trying to time it. We're not here to guess. We're here to respond to the difference between price and value. And like everybody in the world, you want things at a discount. Yet in investing, for some reason, people don't. We want to go where price is below value. When you understand value, you'll be buying great businesses at even better prices. You'll be buying lots of businesses at great prices through ETFs. Let me slow things down for a second and explain what that means, especially if you're new to this channel or investing. When I say buy great businesses at better prices, I don't mean you go out and find some hyped up stock that just dropped 20% and assume 20% down, it means it's a deal. That's not value investing. That's just shopping for something cheaper. Shopping for something on sale without knowing what you're buying. Value means this. You're looking at what the business actually makes. You're understanding its profit, its cash flow, how much it earns year after year, what it might earn in the future. And then you're asking, okay, based on these things that exist and what could happen, what are those worth today? It's like buying your local lemonade stand. The girl next door starts a lemonade stand and makes $1,000 a month. How much are you willing to pay for that? Well, here are some ideas. Is it $1,000 a month year round? Is it only in summer months? Are you in a cold weather climate? How long is the girl going to be doing this for? Will she lose interest in it? If she does lose interest in it, can you bring somebody else to replace them? These are the questions you need to be asking about businesses in general. Look at Nvidia today. Nvidia is absolutely killing it. Why? Because basically one of the few that can make the chips that everybody needs. But when the other companies come around to it and start making those chips, what's going to happen to the price of the chips? Are they going to fall? Are Nvidia's margins going to stay up? Is revenue going to continue? At a certain point, you have to be able to determine what's the right price based on that future. Because remember, the future is unknown. We don't know what's going to happen. We have to make guesses on the future. That's why even investing has a little bit of speculation in there. Now, back to the lemonade stand. If it makes $1,000 a month and she wants to sell it to you for $1, are you taking it? You don't care how long the business lasts. It needs to last one day because you'll make $33 on that $1 investment and you've made all your money back and some. But if she wants $1 million, you're going to be like, hey, sweetie, sorry, not going to happen. But what if she says, I want 100,000. Well, it makes 1,000 a month times 12,000 bucks, 12% return. Okay, let me figure some things out here. That's investing. You've got to be able to sit there and say, one price is obvious, one price is insane, somewhere in the middle is where we need to be. If you understand the business and the price is right and the company is still healthy, there's no reason to panic. Don't go crazy because the ups and downs of the market are causing you to feel like you're right or wrong. The market goes up and down because of everybody else's euphoric or fearful behavior. We always sit there and say, oh, the average person's stupid. Yet the numbers in the stock market are based on the average person buying. So if they're driving up the prices insanely in the short run, and you believe the average person is stupid, why are you chasing that? Or if the price is dropping precipitously because the average person is selling it, why aren't you looking at it? This is what separates investors from speculators, people who build wealth versus people who don't understand how to build it. You don't need to guess the bottom. You don't need to be a genius. You just have to understand what something is worth. And this is the most important part, buy when others are not buying. That's how you win. That doesn't mean that you have to buy things that people aren't buying because they're going to be always wrong. No, they're not always wrong, but a lot of times they are. Value investing is just about buying something at a price that's lower than its value. That's it. If you don't believe value investing works, what you're saying is you think it's impossible to ever buy on sale. To which I tell you, do you ever go to the car dealership and try to negotiate a lower price? When your local store has a sale, do you not stock up on things? This is what brings us to the core of everything we teach on this channel, principle-driven investing. Let me explain what that means, especially if you're new. Principle-driven investing means we follow a system built on 5 core beliefs. These are the rules that I live by as an investor. They keep me grounded when things get crazy, either on the high or the low. Here they are. First off, we are investors, not speculators. Second, every investment is the present value of all future cash flows. Third, if we don't understand it, we don't invest in it. Fourth, in the short run, stock market's a voting machine. In the long run, it's a weighing machine. And the fifth and most important one, a great story can become a terrible investment if you pay the wrong price. These 5 tenets are the difference between gambling and real investing. They force us to slow down, take a look at the numbers, and think long-term. And here's the truth. No one else on YouTube is teaching this. Most creators don't even understand it. They just got lucky doing a Tesla video and it skyrocketed and all of a sudden they're investing experts. I want you to remember there's a process to everything. Everyone is too busy talking about what's going to explode in the next week. That's not investing. If you want to actually build wealth, you need to understand price versus value. That's what it's all about. So here's your action plan. First off, those principle-driven investing tenets, I don't expect you to memorize them. Guess what? I'm going to make it very easy for you. Download our free PDF where it gives them to you and explains them to you in more detail in plain English. They're the rules that help you avoid making more emotional mistakes and stay focused on what actually matters. Guys, I'm going to go walk you through quickly how I value individual stocks step by step so you can start building your own conviction and stop relying on guessing, hype, and hope. Now let's take a look at an example, like I talked about Nvidia. Nvidia is phenomenal, guys. One of the most amazing things about Nvidia is the market cap and the enterprise value are essentially the same. That means there's essentially zero debt on the company. That's incredible. First off, that is one of the most important attributes for a company to stick around for a long time. That's the big reason why I picked Nvidia. It's going to be very difficult for Nvidia to go out of business. Second reason is their free cash flow last year was $72 billion. In the last 5 years, it's averaged $28 billion. This means that their business has massively grown. Guys, they're the clear leader in making chips for this AI boom. Every single company out there who uses AI needs faster and faster chips. And right now, Nvidia is the leader amongst them by far. But like I said earlier in the video, you've got to ask questions. This is not some situation where Nvidia will always be the leader. They might be the leader forever, but guys, when have we seen it? Where, look at Tesla. Tesla was going to be the leader in electric vehicles forever. And then all of a sudden, Ford started selling a lot. And all of a sudden, every other car company starts selling their electric vehicles. And then all of a sudden, Elon Musk gets a little too political for a lot of people's flavor. And all of a sudden, the sales started to fall. Guys, they had declining sales for several quarters. This is something that 5 years ago, 4 years ago, 3 years ago, people couldn't even imagine. In fact, Kathy Wood and Meet Kevin, the fake finance YouTuber on YouTube, they estimated that in 2025 and 26, Tesla would sell a minimum of 5 million cars. Guys, in 2025, Tesla's going to be lucky to sell 1.8 million cars. Lucky to do so. We don't know the future. All I'm trying to sit there and say with Nvidia is, great. It is a great company, but it doesn't mean they will always be growing like this forever. Look at this growth rate. Their revenue growth in the last 10 years has been 41% a year. Last 5 years, 50% a year. Last year, 71% revenue growth. That's a lot. Can they do it forever? Probably not. Let's look what analysts are saying. Analyst revenue growths are, ready? 59, 33, 16, 11, 9. Look at this growth rate plummeting right here. And they're probably still being optimistic. I'm not saying they're right. I'm not saying they're wrong. What I'm saying is, how often in history have we sat there and said something would be amazing forever and it was? Never happened that way. Economies aren't even dominant forever. Great Britain was the country for a very long time. Then the US came along, and now Asia's starting to lead the pack a little bit. It's going to be a while, but they're the ones that are on the next level for becoming the next great society economically. That's the point here. So this is why we do our stock analyzer tool. We have a story, and that story about Nvidia is awesome right now. And it's questionable about the future. Is it going to be as awesome as people think? Is it going to continue its dominance? Is it just going to probably go back to a little bit lower profit margin? We don't know. But what we can do is we can enter low, middle, and high assumptions on revenue growth, profit margin, some sort of earnings multiple, and then our desired return, and it'll tell us the right price to pay based on that. So let's put in some insane assumptions on the low side, insane assumptions on the high side, and a more normal assumption in the middle, and see what comes out here on a 10-year analysis. So here are some assumptions I made about Nvidia, and I didn't make them exactly equal from the middle. I did revenue growth for the next 10 years of 10%, 15%, and then a high of 25%. Guys, 25% revenue growth is crazy over 10 years. Let me show you what that means. That would take Nvidia's revenue up 9.3x from where it is today. That is a big task. Is it possible? Absolutely. Is it probable? That's the question. That's why I have it as my high side. Next, my profit margin. I did 35, 40, and 50% because they've beaten 35 and 40 as of late, and 50 one time. So let's just keep that there on the high side. Now, what is a reasonable PE 10 years from now for Nvidia? Well, guys, I always tell people, you start with the market average of 15 or 16. You go higher for great companies, you go lower for crappy companies. This is clearly a great company. So how much higher? That's subjective. I did 18, 22, and 28. That might sound low to some people. If it is, I don't know what to tell you. Maybe it is low. Could be low. We don't know what these things mean until later on, but we have to make assumptions like we're buying a portfolio of companies. And then finally, to get your intrinsic value, a 9 or 10% desired return. But remember, we're not here to buy at what they're worth. We're here to buy at a discount. If you're going to buy something for what it's worth, just buy the market. Buy a low-cost ETF and save yourself the hassle. But based on these assumptions right here, if I hit the Analyze button, now, these assumptions, 68 on the low side, 434 on the high side, 133 in the middle. So this is a 19% return, assuming the top assumptions occur. The middle assumptions occur, about a 5.25% return for the next 10 years. And if the lowest assumptions occur, a negative 2.5% return. Guys, this is a wide range, but that just goes to show how tough investing is, especially in companies that are in new territory that we don't understand. That's all I'm saying about Nvidia. Yes, it's a company that's been around for over 30 years, but it's dominating a market that's very, very new, and it's tough to determine the right price to pay. Now, guys, I looked at Nvidia quickly, but if you're serious about beating what's coming, you'll need to watch the next video because I believe that stocks will be a lot cheaper from a value standpoint at some point in the future. And that's exactly why you need to learn valuation today. You need to get those valuation skills now so that you're ready when it happens. So in this next video, I'm going to go deeper on how we actually value stocks. That way, when the price does swing, when the emotion swings and the average person is losing their mind, you will be calm. You'll be confident. You'll be prepared to act, and you'll be able to say, everybody else is different. I'm the exception. So the link is right here on your screen. Don't miss it. This is how you get ready for your moment.